Happy 2023 and welcome to another session of Zoom Out with TouTzuSays. This is my 2023 outlook, and we're going to jump right into it because we don't have too much time. Trying to keep this as short as possible. Hopefully you can see the presentation slides on PowerPoint. So yeah, let's jump right into it. Of course, the disclaimers, the key point of that message is I'm biased, I have blind spots. This is for your entertainment only. This is not investment advice. Okay, so I usually like to start with a funny, and this one just caught my eye as we sometimes forget the world is interconnected and things that are happening around the world affect us here in the US. So let's start with a recap. What happened in 2022? Well, here is the big broad look. The bottom is in USD assets, which is relevant for the Americans, for the US. The only things that went up were commodities and oil. Everything else went down significantly. Here's another way to look at it. This is X and Y axis of US stocks versus US bonds. And look, in 2022, we have really extreme outlier. This is extremely weird that not only did stocks drop, but bonds also dropped significantly. This normally doesn't happen. This is different from every other cycle in the history of US markets. There may be a lot of reasons for this. I suspect this has a lot to do with doing QE, the quantitative easing, after the 2008 financial crisis. So we're following the path a little bit of what Japan has done since 1990. But anyways, just suffice it to say, there was nowhere to hide. You could usually count on stocks doing well when bonds don't, or bonds doing well when stocks don't. This year, nothing worked. Okay, the only thing that kind of worked were energy stocks. In total, the US bond and stock market lost a combined $17.4 trillion. So that's the size of the US economy almost. Okay. And when we look across the field at the S&P 500, just at certain stocks that you might know, Apple, Microsoft, Google, basically all the techie stocks, information stocks, they did terrible. The only things that really did all right were energy and some healthcare, okay? And aerospace and defense, which is interesting, which makes sense given that there is a war in the Ukraine. Okay, quick recap. This is what I said last year in June. This was my crystal ball that inflation would be sticky. It would cause unemployment, economy to slow down, bankruptcies to rise. I said the Ukraine war would be a long war. And I said the world is just going in this deglobalization cycle. And I think overall, I've been pretty much right. Last time we did this, bankruptcies weren't popping up as fast and furious. Now they are starting to show up. And even Bed Bath & Beyond, which is a larger public company, that looks like it's in serious danger. So watch out for the news. Rising unemployment, it did rise and then it went back down to 3.5%. Go figure. I think that number is wrong. I think the economy is slowing. I think we're going to see unemployment numbers rise again. So give me a little bit more time. I think those will play out in 2023. Okay, so what should we do in 2023? I think the key factors in my brain are inflation, economics, economies around the world, and the geopolitical risks. So let's start with inflation. These are the key factors that I think caused inflation on the left-hand side here. A little comment on what I'm seeing recently, and this is what I think the forecast for 2023. So let's start with the US COVID fiscal stimulus. Remember in 2020, when we got COVID, the pandemic started, President Trump unleashed lots of money. And then when Biden took over, he unleashed a lot more money. Oh, I shouldn't say more money, but more money. In total, probably somewhere in the range of $5 trillion of fiscal stimulus. And what does that mean? Fiscal stimulus is money that is from the government directly into the citizens of America. So this is money that they actually tangibly received or would get credit for So this is really going directly into the economy. Now, last month, Congress just passed this new omnibus spending bill, which is roughly about 1.7 trillion. But also the last midterm elections, my crystal ball said, the Democrats lost the House, but retained the Senate. Well, we're in for more gridlock. And this new Congress for 2023 is unlikely to agree on much of anything. So this is probably the last fiscal stimulus that we're going to see for a while, at least until 2024. And net winding down of all that $5 trillion, not much is going to come back out, but this new 1.7 trillion that is going to be pumped back into the economy. I'm saying this is going to be inflation neutral. I think people have to adjust to their spending and not having the money from the government, but there is a little bit of fiscal support for the economy for certain, areas that the Biden administration wants to target. So I call this inflation neutral. Also during COVID, we had incredible, ridiculous monetary stimulus. Monetary stimulus is the Fed and what they do with interest rates and how much money they print up in the financial system. So the money supply and interest rates, these are the two factors that they manage, and both are clearly reversing to fight inflation. So since inflation peaked earlier basically early summer, the Fed has been aggressively raising interest rates. And so we all know that already. And what a lot of people don't pay attention to is they've officially started draining money out of the financial system. So in the Fed's mind, they need both of these in order to actually slow down the economy. The interest rates alone might take a lot of time, or they might not be effective because you need people who want to borrow in order for interest rates to kind of hurt. But draining liquidity out of the financial systems, the payment systems, that is something that all the banks and the financial institutes feel pretty much immediately, and they change their behavior because of that. So the monetary stimulus is reversing, and that is a deflationary force for the economy. Okay, it is designed to slow down the economy and cause prices to come down. So that makes sense. The U.S. actually, over the years, we've discovered there's a labor shortage. It's partly because boomers through COVID have decided, I've got enough money, I don't want to risk getting COVID and dying. They've removed themselves from the labor force. But there are other weird dynamics in play as well. People who were ill, people who died. And we have this weird thing where the working age males in the US are just, the amount that they're participating in the labor force has declined over the last decade. It's very, very weird. I don't know why that happens, but it's a relevant factor in how many workers you actually have in the United States to do the work that we want to do. And I think personally, anecdotally, we're already still, it's better now, but we definitely had a labor shortage where, restaurants, there's not enough workers, not enough truck drivers, every kind of service industry, they were still screaming for more help. And that's kept wages really high and slowed down the economy a little bit. So the labor shortage issue means that the unemployment rate this time around probably doesn't go up super high. We've had, during COVID, it went up to like 20%, but I think we probably maximum top out around 5%. And what's interesting is I think wages aren't also going to just collapse. I think it will continue to have positive wage growth, which is actually an inflationary force. The supply chain during COVID disrupted everything, broke all the supply chains. And once we got out of COVID, there was a surge of demand of everybody buying stuff. So the supply chain factor in the economy, I think both of these disruptions are winding down. We've already gotten out. Everybody went traveling this summer, bought all the stuff that they needed over the years. Now we don't need to do that. And simultaneously, the shipping bottlenecks have all come down. So there's no 100 container ships waiting outside the port of LA, waiting to undock and unload. So I think the supply chain issue has now become an inflation neutral thing. I don't think it becomes a deflationary force yet. There's a certain amount of stuff that you still need to buy, but the cost of shipping, ocean shipping at least, has definitely come down significantly. So maybe slightly deflationary, but I call it inflation neutral. There was a commodity scarcity issue. There's, over COVID periods, everybody just shut down. The miners, the oil producers, everybody, because there was no demand. They were losing money every day they produced it, and they have to store it if you produce it. So they didn't want to spend all that money for that. Inventories were down across the board for all sorts of materials and energy. Demand obviously went very low during the COVID pandemic. And that has resurfaced over the last, year or so. And ESG policies by a lot of the Western countries in the world, they're designed to promote alternative and eco-friendly and clean energy. And they are incentivizing those sectors and disincentivizing oil companies, coal miners, et cetera, from expanding production. So what we're seeing is, even though the price of oil's gone up, the price of coal has gone up, and all of those guys are making tons of money because the prices went up, they're not trying to produce a lot more quickly. Because for them to open up a new mine, it's a 10-year return on investment project. And they see that in 10 years, the policies are against them, and people don't like them because the news media doesn't like them, et cetera, et cetera. They're having a harder time financing. They've lost a lot of workers. So they're not in a rush. They're only growing production very slowly. Overall, there's low inventory of everything across the board, but the demand is rising. There's a certain base level of demand that you need for any country to keep operating. But also a lot of countries in Southeast Asia, which huge young populations, and they're growing wealthy, their demand probably will continue to grow. So my forecast is demand actually is going to rise globally still. And what I think is these forces, the commodity scarcity issue, is actually a strongly inflationary force. Demographics, we have the advanced nations versus the emerging nations. I don't think it's hard to understand the advanced nations, like Western Europe, most of advanced Asia, China included. It's just rapid aging in the G7 nations. You do have large youth populations in emerging markets. There is rising wealth and in Southeast Asia, and so these forces on the bottom are inflationary, while the G7 forces are deflationary. Deglobalization, what does that mean? We're setting up trade barriers. We're incentivizing policy to reshore key technologies and manufacturing, and we're blocking out, even blocking sales of things to countries we don't like. Okay. There's a serious, huge US-China tech war going on right now. Biden launched a massive tech war move in September this year, September, October, whereby he basically blocked sales of any advanced semiconductor chips and manufacturing equipment of those chips to China. So China has no access now to any of that. They have to steal it or they have to smuggle it. And that would significantly impact their ability to have the 7 nanometer and lower size semiconductors, which are vitally important for all the smartphones and the AI and the advanced computing and things that they need for a growing economy, both in defense and in consumer spaces. So this is a very, very disruptive thing. And what it means is we can no longer just go to China to source stuff and have them build stuff. We are incentivized now to try to get that from friendly nations. But unfortunately, for most of the Western nations, we no longer have competitive factories and skilled labor. That takes time to build. That's going to take many, many years and billions of dollars. While that does get built out, And that just means it's going to be a very inflationary force on things. You can't get the cheapest, lowest labor, the cheapest things of anything in manufacturing. You're going to have to open up your factory in the U.S. with all the labor cost and benefits and da-na-na-na-na. Europe the same. So this is going to be expensive, and this is going to be a longer term, inflationary force for the world. As you may have heard, China has also recently suddenly unclenched themselves from the zero COVID policy. They overnight shut it off and said, hey, everybody come in. Immediately, they've had massive infections and massive deaths. This is going to continue for a while, definitely through Chinese New Year, I think, into February. But once they reach herd immunity in China, they're open for business. The government in China is readying fiscal stimulus, monetary stimulus. They're going to fully reopen, take the pain of COVID, get everybody with herd immunity, and just start running. And what that means is they're going to wind down all the inventory of stuff that they have. They have energy, they have the metals, et cetera, et cetera. They're going to use up that inventory, which they were planning this. They ramped it up in the fall and winter last year. So they're going to run through that inventory, and when they run out, they're going to have to buy new raw materials. So they're going to end up starting to import inflation into China with the raw materials and goods, probably in Q2, Q3. And then that means they're going to process it, add value, produce it, and then export inflation as well. For those same goods. So China reopening is an inflationary force for the world. The US dollar, over this period last year, the US dollar was extremely strong across the board for all currencies. But this year, I think it's going to kind of diverge, that it will remain very competitive compared to Europe. But to a lot of the other emerging countries, I think it's going to be less strong. And if that were the case, a strong dollar buying European goods, that's a deflationary force. But a weak dollar buying, goods from Asia or Latin America, that's going to be inflationary to Americans. Okay. Next one, Ukraine war, plus any other wars that pop up this year, continued geopolitical risk. It just means insurance gets more expensive, shipping and things get more expensive. All of that will be built into these factors. That's an inflationary force. OPEC plus, the plus is Russia. OPEC is a consortium of oil producing nations that they kind of all get together and agree on what they think is the supply and the demand, and they set production numbers for the countries to comply with. But they're a very important force in how people figure out what to do with energy prices. They have, for one, Saudi Arabia is the biggest player in OPEC, and the Saudis have clearly had a strong rift with the Biden administration. They're not playing ball. They're doing what they want. And, past relations be damned. So they have been pretty forceful, and in cooperation with Russia, they've said all the other reports say demand is falling because of recession problems, blah, 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 lockdowns. So we're going to also cut production because we see demand coming down. Meanwhile, other reports are saying, actually, no, demand is starting to rise as everybody gets out of the COVID lockdowns. And a lot of countries are starting to incentivize, stimulate their country economies. So oil production, demand for oil and et cetera should actually be going up. Whatever the case is, with OPEC being the major swing supplier of oil for the world, cutting production is an inflationary force. This could change sometime in 2023, but for the time being, this is an inflationary force. And as I mentioned, there are other geopolitical risks around the world. There's actually a lot of action going on in the Middle East. Iran is having almost a civil war. The controlling party is dealing with a lot of young people who are protesting, and they continue to protest. They've even captured these young people, have executed them, which is just making this thing more inflamed and go underground. They are a little bit of a dire situation. Meanwhile, Iran is not friendly with Saudi Arabia. So those issues may percolate, and in order for Iran to focus the minds of their citizens, maybe they need a war of some sort. Turkey has been very vocal about dealing with the Kurds. It's a very complicated situation in the Middle East. Many of the Kurds have hideout in Syria and also within Turkey. So the Turkish president Erdogan it's an election year for him this year. He's being very forceful, sending in troops, basically saying, Americans, Russians, I don't really care because all of you guys are distracted with other things. I'm going to go in and take care of this. So there's been a lot of military action actually with Turkey and Kurds and Syrians. Meanwhile, Israel and Iran, those relations have always been bad. They've always threatening to blow each other up. That's ongoing, and Israel recently re-elected their prime minister Netanyahu, who is clearly a hardline, conservative and hawkish type of fellow, and he's installed his government and generals who are very hawkish, specifically towards Iran. So, it's a dangerous situation over there. And when the stands, we're talking about like all the surrounding satellite countries around Russia that used to be very friendly with Russia. Well, they're all having issues now because Russia is so focused on the Ukrainian war. They haven't been able to pay attention or support them. So these stands are starting to speak up and kind of do their own things. There was a conflict earlier this year between Armenia and Azerbaijan. Armenia was a historic ally of Russia, but the Russians said, sorry, we're busy, we're not helping you out. And so they got really pissed off. Anyways, that little conflict between Armenia and Azerbaijan, they settled in a kind of a ceasefire type of thing, but those tensions are still there. And the other stands that are closer over towards China, they've all been vocal about not specifically supporting Russia in this Ukraine war. And China, this is very interesting. President Xi Jinping, the first foreign trip that he makes, he goes to, I forget which stand, but one of the stands. It's like right next to China. That was his first choice of where to go once he decided not to lock himself in China. And that's very telling in the sense that I think he wants to really have Chinese influence to continue doing that one belt, one road policy, build out relations with those neighboring nations that also still produce a lot of key metals and energy. I thought that was particularly interesting. I want to highlight that. Finally, this is a big question mark, but climate change is a factor. And last 2022, we ended up with the third year of La Nina, which is actually a cooling of the Pacific Ocean. And when you cool the Pacific Ocean, it causes repercussions in the climate. And typically, it's been drought for the US. And this year, likely the same. And usually with La Nina, the opposite of La Nina is the El Nino, which is a warming of the Pacific Ocean. And El Ninos tend to bring rain and flooding to the US. But currently it looks like the El Nino may be delayed for 2023 because they thought it might be earlier. They thought it might be in time for the crop season. But right now it is possible that we're not going to get those rains until the end of 2023, which would be too late for the crops. We could be facing a major drought in the US, which would be inflationary. So looking at all of this in aggregate, that's a lot of red. I would say inflation remains high for 2023. it's going to fall from where we were. It peaked out in around 9% in July, I think, of 2022. And it is starting to fall. Today, the CPI number came out to be 6.5, which is great. But does it go all the way back down to 2, which is what the Fed wants? I don't think so. I think there are the natural resources, the energy, those type of things are stuck there. We're probably going to face higher costs for metals and energy still for 2023. And just to make it clear what falling inflation means, I think this is the easiest example. If something cost $100 in 2021, in 2022 with 9% inflation, it cost $109. And if inflation falls to 4%, which is my guess, that same item now costs $113. So it doesn't go back to 100, or it doesn't go to 104. It's still going up. So the cost of things is still going up as long as inflation is positive. So let's make that clear when you're thinking about what to do with managing your cost of living and rates of return that you're looking for your investments. We have to keep that in mind, that we want to beat these numbers and make sure that we have enough funds to live our lives without too much financial stress. Okay, so if inflation comes down, I think the central banks are happy to pause the rate hikes in Q1. And given that inflation came down to 6.5% for the US, it's likely that the next Fed meeting, which is actually end of January, February 1, they may continue to raise interest rates, because 6.5 is still pretty high. You still need to work on it. But the amount that they're raising each time is probably going to come down. So the best guess is a 0.25% raise, one time, maybe 2 times, and we'll see if they pause after that. I also want to highlight that I think that inflation will come in 3 stages, like it did in 1970s. We had the initial rise, that quick rise. We got up to 9%. We're now in the fall down stage, so I think we end up around the 4% range. However, I think we have another rise that happens in 2024, 2025. So is that just commodities, or is it geopolitical risk, or is that a factor of both of them? We will find out, but I think we need to mentally be prepared that there probably is another leg of inflation coming for us, okay? And as a reminder, if the US dollar is weak, that means the US is importing inflation. Last year, the US dollar was strong, so whatever we imported, we're covering because our dollar was strong. So it wasn't as bad for the US as it was for a country like Sri Lanka, where their currency collapsed. So whatever they were buying, they had to spend even more to get that same amount. And it was extremely painful. It caused them to default as a country. Okay. Now, real quick, this is what the Fed does. They call it a dot plot. This is just their estimate within the voting members where they think it will be. They're estimating, between 4.8 and 5.6, and probably by the end of the year, they're thinking 5.1, 5.4. Okay, this is the Fed's guess. Globally, this is Bloomberg's guess on all the central banks. I think what you just really need to note is they think everybody's still going to continue to raise interest rates into 2023. And more importantly, they think everybody's going to lower interest rates in 2024. Okay, as that means there needs to be stimulus here. They're going to cut interest rates. What's in the market right now, this is the thing that Wall Street is most busy with right now. The green line is what the Fed thinks. This is what they think the interest rate will be. The black line is what the market thinks. The market thinks it's below what the Fed thinks. The market thinks that the Fed is going to be forced to cut interest rates at some point in 2023. And here's just a forecast of, something in the financial system breaks and the Fed is forced to, rapidly cut interest rates in order to prevent a global financial crisis, okay? Don't know what that scenario is. It could be a US, treasury issue, or it could be a sovereign debt default by a major country, et cetera, et cetera. It could be a lot of things. But let's focus on these two, the Fed and the market. This is very, very important to think about. Who's right? Is the Fed right or is the market right? Right now, this is telling us the market doesn't believe the Fed. The market thinks the Fed doesn't know what it's doing. That the Fed has lost its credibility and their respect for the Fed. And this is very, very important in the psychology of the markets and the governments. Because what the Fed says, we have to take with some faith and trust, okay? When we lose that faith and trust, their ability to influence markets and the economy significantly decreases. So we have a little bit of a battle now that the Fed, if they sense that the market just doesn't respect them anymore, they may need to double down and hammer it down and make the market respect them, okay? And this could mean, if that were the case, if that issue became the main issue in the Federal Reserve, that means that their interest rates may actually end up going higher and longer. And they, even though there may be a need for the economy to get stimulated, they may delay that and cause a longer recession. Okay, so I'm kind of in the camp that I think the Fed is fighting for its credibility. Their enemy is the market. I think they have the ability and the intent to regain that credibility, regain the respect the market needs for the Fed to do its job. So I'm guessing, my guess is that they will pause and then leave interest rates there for longer than they're supposed to. And if that is the case, then the recession could last longer than it's supposed to. Okay. The other side of the coin is the Fed's balance sheet. You see that they have reversed QE and they're starting QT. QE was money printing. It's reflected here in the Fed's balance sheet, and QT is money draining. They're draining cash from the financial system. And they made that plan. They officially started it in June last year. They turned it to 10 in September, and I don't see why they would stop this unless something breaks, okay? So just remember, I've shown you in past presentations, liquidity is hugely important to financial assets. When there's plentiful liquidity, we take bigger risks. And when there's less liquidity, we're more careful. We're like, should I buy that car and get a car loan? Oh, in the past, it was only 1% for that car loan. I can cover 1%. That's easy. That's only a few $1,000s. But now if it's like 6%, well, hey, if I screw this up, can I afford to pay that all the way through? If the economy goes into recession, am I going to have a job? Can I pay that? Well, it changes your risk appetite. And this is the underlying factor that is affecting the financial markets, which will eventually affect stock prices, bond prices, and maybe it also affects the real economy. Okay. Now let's go into the economies. Here I'm just highlighting big three chunks. Europe, I think, is going to be in a deep structural stagflation recession economy for several years. The point is, Europe, specifically, let's look at Germany, which is the powerhouse country in Europe, in the EU. They are designed to export, okay? They import materials, they put it into a factory and export cars and heavy equipment and chemicals and et cetera, et cetera, et cetera. And their primary customer was the rest of Europe, but also they care about the US and China. Now, with the war in Ukraine, every single material that they need for production, whether that's aluminum or oil or natural gas or whatever that is, their costs are the highest in the world. I mean, China's getting a good deal from Russia because they're buddies. The US, we produce our own energy and fertilizer and et cetera, so we don't need those high prices. We export all of that to Europe, and they have to pay for high shipping, and they have to compete with other people who want the same thing. they've been paying the top dollar to steal, I shouldn't say steal, but divert natural gas that was going to Asia and divert it back over to Europe. So they just had to pay up for that. And with no resolution to this Ukraine war and the relations with Russia, they will continue to pay for the highest material costs, which makes all their goods much more expensive and less competitive for their economies. So this is a structural thing. This is a long-term thing. And then now you throw in that they're all aging incredibly. This is a major factor for the not having enough demand for their goods and all their goods being very expensive. So this is going to be a huge challenge for Europe. It's going to take at least a couple of years before they can get energy costs back down. And that's assuming that the current war situation remains as it is. The US, I think it'll be a little bit shallow, but a longer recession for the reasons I explained. The labor force is shrunk. So unemployment rates will remain fairly low. Wages will remain decently high. So there's going to be a built-in certain level of economic activity. But if interest rates remain fairly high with the Fed not lowering interest rates, we could be in for a long, slow, kind of sticky, kind of stagflationary environment in the US. Okay. And China, as I mentioned, they've unclenched. They've decided they're going to go full out. They're adding stimulus as we speak. Chinese New Year's comes early this year. It'll be in January 22nd, I believe. And China goes on holiday for the next week and 2 weeks. But come end of February, March, I think the government and the people are excited to get things going again. And in the aggregate, Europe and the US go into recession, and China is probably the main growth engine for the world in the second half of 2023. Now, looking at a little bit more charts, this Michael Burry, he was a hero in the Big Short book about the first financial crisis. Anyways, he's kind of mysterious, but often followed analyst and investor. He shared this chart, which is a chart of the number of states with negative economic growth. And his thing was, if more than half of them are experiencing negative economic growth, pretty reliable indicator of recession. So it's crossed the line, and he believes we're heading for a recession. The small business indicator has also collapsed. It did have a little bit of a bounce, but small businesses in America, which actually are the core of the businesses that creates jobs, they've been having a hard time, and it may bump around here, but this tends to be a very negative effect for the economy. U.S. households lost a lot of money in 2022. So in Q2, I don't know what the number is. Q3, their net worth dropped by 400 billion. Oh, I'm sorry. In Q2, the net worth dropped by 6.3 trillion. In Q3, it dropped by 400 billion. We don't know the Q4 number, but it's a lot of money. Households, whether their home values or their stock investments, they all came down a lot. Americans are feeling less rich than they were. That's important. It kind of reflected in the Cyber Monday, Thanksgiving, Black Friday. Credit card spending numbers weren't that good. This is from Bank of America's internal data. And what we're seeing is year on year personal spending, although it rose, but it was just a little bit, while the American savings rate has plunged to 2.3%, which is hugely low. Meanwhile, credit card debt has just climbed and climbed and climbed. So if we were to guess, it means that I have less money, I'm still spending down my savings, and if I can't afford it, I'm using credit cards to cover it, and I'm hoping for the best that everything works out. And that's a very dangerous situation. So 2023 could be a serious consumer spending recession. especially in Q1, Q2, and that will reflect in corporate earnings and et cetera, et cetera. ISM manufacturing index has been declining, and now it's below the 50 level. Above 50 means expansion, below 50 is shrinking. We're down here 48, 46. Globally, it's all below the growth numbers. And that's manufacturing. We also have to consider the services. The services CPI, and the cost of getting service, like going to visit a doctor or having your mechanic fix your car, excuse me. All those costs went up because their base costs went up, whether it's wages or their material costs and, just costs for gloves and masks and, and bottled water. All of those costs went up. So those are still rising, as is shelter inflation. Even though shelter inflation has come down a bit and it's a very lagging thing that shows up, but it's still got another 3 months or so before we start to see that show up in the official CPI numbers, inflation numbers. This is a conundrum. I'm not smart enough to figure it out, but as I mentioned previously, there are 2 surveys of how unemployment is counted. One is the establishment survey and one is the household survey. They're both done by the Bureau of Labor Statistics, and the establishment survey is the ones that we get published and where we say the unemployment rate is 3.5 or 3.7. The weird thing is the household survey shows negative growth. It shows job loss, okay? And the Philly Fed, which also studies labor, they said, hey, wait a minute. This gap, there's something wrong. I think the jobs data situation is overstated by at least 1.1 million jobs. So here we have a real issue, and I don't know how it gets evolved. I think underlying all the numbers and statistics, remember the household survey is per household. So you could have, for this household, are they employed or not? Okay, the establishment survey is based on jobs. So this one person can have 2 or 3 jobs and it will show up in this number. Okay, so the multiple job holder thing is really the main discrepancy between these 2 surveys. And it looks like, it's not as robust as we think. So unemployment numbers, even though they're saying they're really low, there is stress in the economy, and it's not as robust and strong as everybody believes it is. Okay. And again, here is another confusing factor. Unemployment, first-time claims, all of that stuff, they continue to go down in December, which makes it seem like the Fed could keep trying to slow down the economy because it's clearly not creating job losses. All right. The IMF basically said most of the world is heading towards recession in 2023. When we look at the expansion contraction indicators for the world, yikes, they're all red. Makes sense. It also means that, the whole world's debt, it's just been going up and up and up. There's a lot more debt, a lot less people in the Western countries to pay the debt. There's not enough growth to pay the debt. This could be a problem. To get a little bit more granular, looking at just the G7 levels of debt compared to the GDPs, we're seeing debt levels at over 100% for the majority of the G7 countries. So the United States in 1970s, this number was around 34, 35. Now it's up to almost 130%. Okay. Side note, famous economists from Harvard, they wrote a big book about this stuff. They said when countries exceed 100% of GDP to debt, they tend to start to shrink and have trouble. Okay, so in this picture, surprisingly, the UK is below and Germany is below. Look at Japan, it's almost 260% debt to GDP. Yeah, these are not healthy numbers. Okay, so here's another way to look at it. In 1950s and 1970s, The debt to GDP ratios in green, it was, 1.5. Now it's 3.6. We have 3.6 times the debt compared to what your economy is able to produce and grow. Now, in the macro, countries are immortal. So this does not mean impending doom for the US or anybody, but it means that growth, economic growth, healthy economic growth is likely to be very, very slow for a long time. Okay. And when you look at this in another way, just thinking about, you owe money and how much interest you need to pay on it. The US debt interest costs, I think, for 2023 are likely to exceed $1 trillion. So in the last 2 months, we spent $103 billion just to pay interest on all the debt that the US government has. Now, that was okay because in the past, we are paying 1%, 2%, 3% interest on that. But when the Fed raises interest rates, we're going to start having to pay 4%, 5%, 6% interest on that same debt. That gets expensive. And, in comparison, the US defense spending is about $800 billion for 2023. That's in the budget, $800 billion. So we're now spending more money just to pay interest than we are to defend the United States. And the US has got the highest, defense spending in the world by far. We're spending 1.3 for Social Security, 1.4 for Medicare. We're spending a lot of money just to keep the things in motion. What we really need is economic growth, but where are we going to find that? That's looking to be a challenge. Developing world has a lot of debt too, 2.5 trillion of debt that comes due over the next 2-3 years. Countries like Pakistan and Sri Lanka, Zimbabwe, et cetera, Argentina, Turkey, everybody's in a very bad spot. And how they manage this is not going to be easy. And there will be some more country defaults, I'm pretty confident. Meanwhile, China has produced a lot of their own issues and debt, but like I said, I think they're starting to stimulate their economy. This is the China credit impulse, which is the indicator of how much animal spirits are in the economy and how much money is being pushed through to feed the animal spirits. During COVID, China locked down, they crushed their own property markets, they crushed their own tech companies. It drained money from them, from the system. They slowed down that credit impulse. But you're seeing that since 2022, they have been slowly releasing the floodgates again. And my guess is that this will get back up to historical levels to try to stimulate 2023's China economy so the people are appeased, because they were rather pissed with the whole lockdown and how it was handled. So this is coming for China, and it will affect the world. As China grows, like I said, they're going to need to import more raw materials of things in order to produce more goods to sell. All right, let's talk geopolitics here. This is what I see. I think Russia, given their failures on the ground in the military, they keep changing their head generals. Then you go into the winter, and winter is a tough period for both sides. And if it's muddy, nobody moves anything. The tanks can't move, they get stuck. If it's frozen, they can do something quickly. And don't forget, last year, Russia also drafted 500,000 soldiers. And about 200,000 of them escaped and ran away and didn't want to be sucked in. They still probably have roughly 300,000 new soldiers that they're training and preparing. You're hearing weird stories of they're just taking prisoners out of prison and throwing them in the front lines. And there you go, there's a soldier. And if they don't fight, then they are basically executed on the field. Whatever Russia is doing, they've gotten a slap in the face. Their military looks inept. They've amassed resources, weapons, and troops. And I think that in Q1, at some point, they're going to launch a major hard counteroffensive. And what that means is the Ukraine ready? Have they been supplied with enough intel and weapons from the West to deal with that? I think we're just going to see in the news an escalation of war and of horrible deaths. So that, I think, happens sometime in Q1. China, as I said, they're trying to reopen and try to re-engage the world. Specifically, they're fighting a tech war with the US. So what they really, really need is the Europeans not to join the Americans. I think they're going to launch a major charm offensive towards the EU and the rest of the world, trying to create doubt, trying to create division within the Western alliance. We'll see how that goes. But I think we're going to see a lot of that positive energy and press in 2023 from China. As I mentioned, they unclench, they're going to drive domestic demand, import inflation, export inflation. Globally, this will be an economic engine for the world. I'm really worried about some kind of shooting war in the Middle East. I think that could pop up at any time because they're ongoing already. So with any kind of conflict in the Middle East, it just means oil prices go up. So that probably affects inflation around the world. We talked about La Nina and the delayed El Nino. Just keep that in mind. Nobody can predict weather that accurately, but historical patterns and historical charts, we can use those as references to figure out if this were a more likely scenario than not. One thing from last year, there was a huge explosion in Tonga. It was an underwater volcano that blew sky high. It was huge. And what it did compared to above ground volcanoes, when they blow, they spew ash and sulfur into the atmosphere. And that tends to have a cooling effect as that stuff just coats the world and blocks energy from the sun. The Tonga explosion, it didn't blow sulfur and everything up, it blew steam, water. So what that tends to do is have a warming effect on the globe. And so nobody really knows what this is going to do. There are a lot of people who are following and trying to figure it out. And this could be the reason why the El Nino is delayed. But this could be one of the factors. In any case, it's very fascinating. Just remember, there is a reasonable risk that El Nino is not going to show up in time. It could be another year of severe drought for the North America. And if that were the case, then you will definitely have food inflation revive itself. Finally, U.S. political and economic gridlock because Congress is divided, et cetera, et cetera. We just have to be aware that there's nobody to rescue us. So again, new general in Russia, could be an escalation in the war. The Ukraine battlefields are freezing. That makes it easier for tanks to get going if they wanted to. Don't know if that's the thing to do. Russia set up more missile bases in these islands that are disputed with Japan. Who knows what that is, but the chess pieces are moving all around the world. Recently, the US has added a huge contingent of Marines in Okinawa. Japan signed off on it. They are getting ready the Southeast Asia theater in case China does something foolish. And what that means is the general was saying, in 2014 in Ukraine, they decided that it was a risk. So they started keeping extra stores of things in the area in different places for security. That's what they're going to do now in Asia. So the Philippines, Japan will probably get extra stores of equipment and manpower, probably Guam, just in case something happens on Taiwan. Okay. China, like I said, they're getting ready to stimulate things. They think that, they've already put in, I should say this, they've taken away the restrictions that they put in place to kill the property markets. So there's room for that to revive quickly. Scientists from China and the US, they go to conferences, they don't mix. They're not talking to each other. So this is an interesting random article that I saw that, when they cite papers, they're just not cooperating. They're not sharing information, even though they're publishing it to the world's scientific community. JP Morgan says globalization's demise is the major theme for 2023. So yikes, I'm not the only one. I've been talking about deglobalization for years now, and I think we're definitely entrenched in this trend and this cycle. Even other countries seem to think things are bad. Informal survey, Australians are the most likely to think that World War III is coming with 81%. That's pretty terrible. And of course, Australia was the direct victim of conflict with China. China's got mad at them and stopped all imports of everything, wine and coal and etc. Out of necessity, China has restarted importing coal, and we'll see how that goes. But clearly, the world is not unified and happy-go-lucky. It's not globalized anymore. There's serious concerns and tensions building all over the world. I'm resharing this one because it's still so relevant in my mind of how to think about the world. We like clean energy, battery, electric vehicles, no pollution, et cetera, et cetera. They're produced, mined all over the world, but they're all processed in China. And this needs to reverse in a deglobalized world. This will reverse, okay? And to fight the US tech war, China's throwing $143 billion at their own semiconductor industry, which in price parity terms, that's probably worth, I don't know, in US terms, more than that. It's, probably 200 billion, 250 billion. Meanwhile, the US has thrown, 52 plus 24, $75 billion of money and incentives to reshore semiconductor manufacturing in the US. So this is a big war, and it's a lot of money that is getting thrown around. Saw this on a Twitter. Basically, the Russian National Wealth Fund and the Russian, the Bank of Russia and their foreign reserves, they don't have friends anymore, and they get a lot of good stuff from China. So they've now doubled the amount of what they're allowed to maintain of Chinese RMB, yuan. They doubled it to 60%. Now, if you think back 20, 30 years, the US dollar was the main currency for everybody. The Chinese yuan is moving up in a lot of countries' ledgers, where they're setting up swap agreements, allowing higher levels of holding of RMB. What this means, it's not going to happen overnight, but what this means is China is also launching a currency war, trying to displace the US dollar. And they're doing a good job, because right now Russia and the Middle East, they've all been accepting much more Chinese renminbi. Okay, it used to be they would have to buy oil using dollars from these countries. Now they're directly buying it in renminbi. And what that means is now Russia has a whole bunch of renminbi. They'd rather spend it on China, either buying goods or Chinese bonds. Same for the Middle East, and probably a lot of the Latin American countries as well. So this is a serious threat. It's not a concern right now, but if it goes unabated for 10 years, the US dollar's primacy could be eroded, and that could cause serious financing problems for the US in the future. Okay. And as I mentioned earlier, we're paying more now for just what we're paying for our interest on our debt. And with a new Congress, with a new House led by Republicans, this will be a fight. The Republicans have been saying strongly that we got to get our fiscal house in order. We're spending way too much. We want to cut all these things that Biden has promised, the Democrats have promised. There could be a huge fight for the debt ceiling U.S. debt ceiling. We experienced that during Obama's time, shut down the government for a while, lowered our credit rating, et cetera, et cetera. I would say it's likely that we're going to have the same issue this year in 2023. I don't know when this might happen and when this debt fight might occur, but I would say it's highly likely it's going to happen. Okay, and yeah, we talked about El Nino, La Nina. I won't repeat it here other than, when you see these charts, El Nino tends to bring rain into California and in the US generally, so that's good for crops. La Nina tends to do the opposite. And if El Nino does not show up early enough by the summer of 2023, our crops could end up just drying out and having a bad crop. Okay, now I call this 4D chess because the fourth dimension is time, and timing is everything in investing, and it's the hardest one. Here are a couple of trigger dates that I see might be important for the markets and for the economy. We're in the middle of a buyback period while companies are announcing earnings. We need to, they're not allowed to buy back their own shares. So a major buyer of US stocks is right now sitting on the sideline, okay? Q1, I think there's a Russia counteroffensive. I don't know what that might look like, but could be bad. Could have an unexpected surprise. Earnings starting Friday, the 13th. Today, the financials are going to start announcing their earnings. And then that runs into mid-February before majority of companies announce. And as companies announce earnings, then they're allowed to, again, buy back shares if they wanted to. Chinese New Year's, January 21, 22. That means China is off for a week thereafter or two, depending on a country, on companies. Fed meeting, end of January. I think 2023, if there's a recession, corporate share buybacks is going to fall down quite significantly, but we're going to be able to see that in Q1, Q2 times. Other Fed meetings. Here's an interesting one, the Turkish general and presidential elections. This is Erdogan wants to be reelected again, and he's doing everything in his power to control the press, to keep interest rates down, to fight the Kurds and get the patriotic juices going, et cetera, et cetera. Make no mistake, Turkey is at a critical juncture in the world. By its geography, it's one of the most important right now in the world. They control the access to the Black Sea, to the Russian exports of energy and food. They're right next to the Ukraine and the Middle East, which produces and exports all of that energy. Everybody needs to appease the Turks right now, as the US and Russia are distracted. Market sentiment quickly, retail investors, they lost a lot of money. They sold out a lot of stuff at the end of the year. The fast money guys, the hedge fund guys, they've been watching and kind of sitting on the sidelines, but they're very tactical. The longer term institutional money, they lost a lot in stocks and bonds, but they have mandates. And I'm thinking maybe they want to reestablish some of their bond holdings as that becomes a little bit more attractive. So those are some of the sentiment and flow things that I'm seeing. Here are what I see are the S&P 500 trigger levels. We probably stay in this range for a while until it breaks above or below. We're right here now. Today we're at 39.85 or something like that. Could run up to 4,000-ish, but that is a very tough resistance level. Okay, to break through that, you need some really good news and real hope for economic growth or something. Okay, my guess it might hit that ceiling and start to run back down. If it runs back down and drops below this critical support level, it could mean people really are believing the recession story and they're starting to take risks off, and all the earnings that they thought companies would have, they're going to discount them. So we could see a more significant downdraft if it breaks below 85, 38, 38.50. Okay, so again, here's the retail traders losing 350 billion, selling out of their stocks and mutual funds and stuff. One analyst I've read was saying that every market needs a market leader. It used to be tech stocks, which we've enjoyed for a decade. I mean, look at that. It just keeps going. They led and led and led. It downturned significantly. Are they going to rebound and be the leader again? Or will there be a change in leadership as I think will happen? This is energy. It was just unloved until this year. And does this keep going? I tend to think yes. Okay. So roughly one analyst did a comparison, estimates S&P 500 with no recession, fair value 3,500-ish. If it was a mild recession, 3,000-ish. If it was a hard recession, 2,400-ish. Okay. So just roughly to keep those levels in mind. This is much more wonky. I won't go too much in detail, but we've heard of the inverted yield curve and how that is a very reliable indicator of recession. When you analyze all the different charts and the different combinations, apparently the 3-month, 30-year curve is the most accurate. And what you want to see is that curve steepen and the 5-year, 30 years uninvert. And that means recession within 2 months. Okay, so, okay. Grain of salt. When you see the interest rates, the yields of US Treasuries move around, those are the ones to kind of pay attention to see if we're quickly going to head into recession. Okay, so here's the good stuff. Robin's crystal ball for 2023. First off, my Seahawks snuck into the playoffs. They're playing their season rivals, San Francisco 49ers, who've been rocking and rolling all year on Saturday. And there's my 50-50 prediction. I think the Seahawks are going to win. So go Hawks, okay? To re-emphasize, I think Russia has a large counteroffensive in Q1. And then maybe that leads to negotiations in the summer if they're successful. I think inflation will fall, then flatline around 4% before rising again in 2024 and beyond. I think the US recession will be shallow, but longer than people expect, with unemployment not going above 5%. I think the Fed is going to pause in Q1 and continue to drain the financial system with liquidity, which makes it financially a tight environment, which will slow down the economy. And because they're fighting for their credibility, I think they're going to pause longer than they're supposed to. And that will surprise the market and cause even more economic pain. China's unclenching is going to be an inflationary effect on the world, but I think they're going to be one of the main economic growth engines of the world, while the Americas and Europe are going into slowdown, okay? I think energy and base metal prices are going to remain elevated. Yes, when you hear recession, you think a destruction of demand. However, I think that the energy demand went super low for COVID, and now we kind of have a post-COVID baseline of we're out of COVID and we're working from home. So that baseline is still there, okay? That demand is there. It's not going to be going away. However, the global picture, especially in Southeast Asia, where they have young populations that are wealthier, the global demand for these things, I think, continues to surprise on the upside. So I think those commodity-related things continue to do well in 2023. In this scenario, I see the U.S. market dropping in Q1, but I think it rebounds by the end of the year. Okay, I think the dollar strengthens against the euro, but not against the other currencies around the world, which actually make emerging markets and commodities attractive. Okay. Finally, I think real estate. A lot of people ask about real estate and Is this a good time? Prices are going to come down. I think real estate will mean revert throughout 2023. I just don't see them. Okay, the juice that fuels real estate is lower and lower interest rates. And we've had lower and lower interest rates in the US for about 30 years. Okay. If interest rates are now going to stick around at a high level, it will definitely make real estate less attractive. You need that leverage to do real estate, and you need that borrowing. Yeah, nobody has, well, not nobody, but most people don't have, tens of millions, hundreds of $1 millions of cash just hanging out. They pay a down payment, borrow it from the bank to get that, big property, and they pay it out over 30 years or wherever. That really dampens that appetite. And I wanted to show, I'll show you later about a little bit more detail about the real estate market. And here's a chart of why I think real estate inflation is going to go in 3 stages. The orange is inflation from 1992 to 1984, and the black is our current inflation. And we see it come down, 1970, go up 1972 to 74ish. It comes down for a little bit, and then it revives itself. And that was very much, the oil crisis and all those factors playing in together. What's important to note, though, I think I put it over here. In 1972, the U.S. debt to GDP was 34%. So we didn't have much debt. We were producing as an economy very well. We're only borrowing a little bit. And remember, the demographics at that time were the boomers are just growing up and they're entering the workforce. We had a huge population year after year of more spending and more economic activity. In 2022, our debt to GDP, I think that's actually wrong, is 128%. Boomers are retiring. There's a huge cohort that is retiring, spending less. The rest, the millennials, didn't quite make as much money because they had 2 crises in their lifetime. They're struggling to establish themselves, set up families, make more money. It's a large population, but it's much more like a tube rather than a spike. These are factors that make all this just a little bit more dangerous for the future. Okay, so where to invest? I'm going to run through these really quickly. Just on a macro level, who has lowest input costs? Who has technology? Who has the labor force? Who can protect and defend their things from competitors? What companies have positive cash flow, want to continue paying dividends? What are the supply issues? Who's getting constrained? What supply is growing? What supply is shrinking? Same with demand. What bottlenecks exist? This is typically regulation or calamity or whatever, but those are all important in the short term to figure out the supply and demand balances and where prices are going to set. Okay. So for this earnings season, as I said, S&P 500 companies, 77% will announce their earnings by February 10. So we're going to get earning announcements coming fast and furious. Goldman Sachs believes that the markets are optimistic about earnings growth. The consensus is 3% earnings growth. Goldman says, no, we think it's 0. Last quarter, which sectors did well? Energy had great earnings growth. Industrials had good earnings growth. When we look at the stocks, who did well? These are all oil and gas companies. This is wrong color. This is for solar, is a solar company. These are the companies that did well last year. These are the stocks that did well, okay? Everything else kind of did pretty bad. So going forward, if we're looking at Goldman Sachs estimates of earnings versus what the consensus says when you add up all the S&P 500 companies, we think it's $229 per share of earnings. And then you multiply that by your PE ratio. So let's just say, 15 or 17, whatever that number is. That's a huge gap between what Goldman Sachs thinks is going to be the actual earnings of US companies in 2023. Okay. Huge drain of inventories of all US energy. crude oil, gasoline, distillates, which is jet fuel and diesel. The EIA thinks production is going to ramp right back up in the US. The US now produces as much natural gas and exports LNG as Qatar, who used to be the top dog, which is really pretty cool. However, this is what the industry believes, that who's going to invest in building out production capacity for oil and natural gas? They don't have high expectations, which is why I was talking about maybe the ESG policies are disincentivizing companies who are really going for it and producing more. It means slow ramp up of energy production globally, and that could be an issue. A lot of people, because of OPEC, also believe we're in an era where we're just not going to have cheap energy anymore until we get alternative energies to really ramp up. Maybe the fusion technology works and we can build fusion reactors, but in the meantime, we're going to rely on these fossil fuel carbon-based energies, and we're going to keep growing the solar and wind and all that stuff, but those really need batteries or nuclear in order to be able to run 24/7 instead of in cycles. When we look at the PPI, which is the inflation for materials, they say this is a leading indicator for earnings. And well, oil tends to predict PPI. So if oil prices are high, PPIs tend to go up. Okay, makes things cost more, means earnings go down. Glencore is one of the largest commodity traders in the world, as well as an owner of mining. And there's a cumulative gap of 50 million tons between 2022 and 2030 for copper. So I've talked about copper previously, huge lack of production capability, and you have geopolitical issues, protests that shut down mines occasionally. This is an issue, especially if we are going to have an electrified world. You need copper. There's just no substitute for copper, and nobody's mining it. And China already has some inventory where they're going to drain it down pretty soon. They're going to need to reorder, and there's not going to be enough copper. So copper prices actually over the last month have been going up from the bottom. Estimates even up to $10,000, $15,000 per ton, compared to current around $8,000 to $9,000 per ton. Refining is a big issue. Look where all the refining is done. Look, China is still a major refiner of the metals. So that's a thought. I don't have the key to this, but suffice it to say, electric cars, because of the materials costs, inflation, they've doubled. So electric vehicles, they may be a great thing, a savior for the future, but expect electric vehicle prices to not be cheap, and therefore that'll slow down the adoption. Therefore, you're going to have an existing installed base of gasoline powered vehicles that are going to need fuel. International valuations, all the stocks around the world, they've just done terrible against the US stocks. So they're dirt cheap. So if the US dollar starts to weaken, it makes the international stocks much more interesting. So keep an eye on that. Buybacks, as I said, was a major long-only buying force for the US stock market. If we have recession, Goldman expects that would drop 40%. So we peaked out at a new high, over $1 trillion of share buybacks. That means companies spending money, $1 trillion to buy back their own shares. That means what's left over in the market for us to buy and sell. I mean, there were, let's say, 100 shares, now there are 80 shares. And so usually that drives the price of the stock up. This is starting to reverse. So this is another headwind for stocks. Central banks are buying gold. China just added another 30 tons, and I know they had just bought 30 tons in the fall. Maybe these precious metals are going to get their second wind. Okay, now let's quickly go through real estate. So for the US residential real estate, it's broken into existing homes and new homes, okay? Existing homes make up 85% of transactions, new homes about 15%. We're already seeing the annual pace in 2020 was around 6.7 million homes being bought and sold. We're going to probably go down to 4. Now, the month supply of existing US homes is only 3.3 months, which is a very low. So there's not much inventory of existing homes that's on for sale, okay? And the normal rate is around 5. New homes, which again, whereas 15% of the total, they have a month's supply that went from 3.5 up to 8.6. So there's a huge amount of new homes out there that are sitting around not being sold, okay? That's interesting. So when new homes, oh, here's a point that, you know, all that data is kind of old, but a lot of people are canceling that they put down as, I want to buy a new home, but now the recession's happening. It's like, no, I cancel, I'm not going to buy it. Those cancellations probably going to start showing up significantly over the next few months. And let's see. And so the month supply of US housing, when you aggregate those two existing and new homes, you get around 4.1%. And for a lot of people, they think, okay, that's a tight inventory situation. Therefore, when demand comes back, it's going to revive and rebound really quickly. What this analyst was saying is, well, hold on a second. Now, who sets the price? Is it the guy who's trying to sell his house, or is it the home builder with 20 houses that he wants to sell and with high, you know, inventory levels? It's probably the guy, the new home seller, the home builder who sets the price. Because once they set a price, if those 20 homes go down 20% so that they can try to sell it, all the homes in the neighborhood will also probably thunk down with that price. So that's very interesting to consider, that even though the inventory levels are low and indicates tight inventory, the reality is new homes are not tight, they're in excess. Those are the people who are setting the prices. So we probably should expect home prices to continue to go down until the inventory level of new homes comes down to a more reasonable level, okay? So nationally, prices have been finally coming down. I think they're coming down more. And just to give perspective, real estate is actually the biggest market of all the investable assets. The bond market is the second largest, and here are the stocks. So it's important because with the real estate market goes construction materials and construction services and employment of a lot of, you know, hundreds of thousands of people. So that could all have serious effects. Okay, and finally, I'm going to leave you with these investment themes. I shared this last time. I have short-term, mid-term, long-term ideas. Focus on the short-term with cash-generating sectors, strong companies. When we want to look out a little bit further, I'm thinking about defense, energy, chemicals, semiconductors, things like that. And then longer term, we're talking about the cool technologies that will get us in, grow over the next decade. Okay, so that's it for now. Remember, don't panic. And I hope you've enjoyed this. If you have any thoughts or questions, feel free to let me know. Until next time, take care, be well.